All right, everybody. So let's get started. Welcome to the fourth of the online PhD level classes in empirical household finance. For those of you who haven't attended a previous one, I'm Johannes Ströbel, and today's class is going to be talking about various topics related to mortgage, borrowing, and default. So my plan for the next hour is to start out with an introduction to the topic, some observations that I have, and really trying to sort of summarize what I think are some of the interesting questions that people in this space are working on, and also some of the questions that I think deserve more work. What I'm then going to do is I'm going to present a research paper, asymmetric information about collateral values, and then we have 7 other presenters lined up for the rest of the day. You can see the program online, and then at 5 p.m. Eastern time, we'll conclude like we do in previous weeks with a panel discussion amongst the various presenters, where we'll discuss what we think are interesting open questions, some approaches to research that we have, and just to give you some sort of insights into the research process as we view it. So I want to start out talking about mortgages, and want to start out by motivating why mortgage borrowing why we think mortgage borrowing deserves its own class, its own sort of sequence of presentation, separate from a lot of the other consumer credit categories. So this is a graph that many of you have seen before from the New York Fed consumer credit panel, and it just shows you, at least for the US, the total amount of outstanding consumer debt by category. And one of the sort of striking facts here is that mortgage debt, which is the orange bar here, makes up more than $9 trillion worth of debt, and is by far the largest consumer debt category out there. And so in part because it is so large, it has important macroeconomic implications and has really attracted an enormous amount of research over the past few years. The other reason why it has attracted so much research over the past few years is if you think back to the 2008-2009 financial crisis, under a large number of narratives of that crisis, excessive consumer borrowing was really at the heart of the of the crisis. And so here's a cartoon that summarizes this up, where everyone goes and says, look, this is all your fault. You bought a house that you couldn't afford. But the narrative is one where people took on mortgage debt, and then as house prices collapsed, as the economy went to recession, they couldn't repay those mortgage debt, and those mortgages either sat on the balance sheet of banks or were bundled into mortgage-backed securities, who were then held around the world. And so the inability of households to make their mortgage payments, under this narrative, were at the heart of sort of the driving force of the financial crisis of sort of the 2000s. And so following that, there's been just this explosion of research by the finance and economics profession, really trying to understand mortgage markets much better than we previously did. And so all of the presenters that you'll see today were in graduate school either around the time of the financial crisis or shortly thereafter. And to us, this seeing this sort of global recession originating from largely originating from the U.S. housing market was something that obviously put this specific market and this specific consumer credit market sort of squarely into our interest. And so that's kind of the motivation of why so many of us in household finance, but also in macro finance, asset pricing, etc., spend so much time trying to understand mortgage markets better than we usually do. So if you think about mortgages, this is going to show up across a lot of the different presentations today. There isn't, such a thing as a simple mortgage product. Mortgages can potentially differ on many different dimensions, which might play an important role, in the various research topics that you study. So the first one is that mortgages might differ in terms of their types of interest rate settings. So you can have fixed rate mortgages, which are the most common type of mortgages in the US, where the interest rate is fixed for the duration of the mortgage, or you can have adjustable rate mortgages, where the interest rate that you pay every month varies with the federal funds rate or with some other sort of benchmark interest rate. Mortgages differ by the amount of leverage that people take out, right? So do you borrow the entire amount you need to finance the house, or do you only borrow a fraction of what it costs you to finance the house? And again, many of the different presentations today, the leverage will play an important role. Mortgages differ in their duration. So again, in the US, the most common mortgage would be a 30-year fixed rate mortgage, but you can also take mortgages with much shorter durations. And in many European countries, it's much more common to say take a 5 or a 10-year mortgage. And again, there's sort of various different types of trade-offs as you're thinking about, what duration should you pick, what leverage should you pick, what interest rate should you pick. When you think about interest rates, mortgages can get even more complex. So you might, for example, have teaser rate mortgages, which during the first few years of the mortgage, actually the interest rate is lower than the steady state reset rate it subsequently goes to. And those teaser rate mortgages played an important role in this financial crisis that I highlighted earlier on, in part because it allowed people to borrow at very, very low monthly costs, at least initially, in the hope of prices increasing, and then people were sort of hoping to refinance those mortgages down the road. Mortgages differ in terms of whether or not they're government insured. Or whether, and this is sort of in particular important when you then think about the resale market for mortgages, the secondary market for mortgages, as people package these mortgages into mortgage-backed securities, a subset of mortgages will get an insurance guarantee by U.S. government agencies such as Fannie Mae and Freddie Mac, and so whether or not mortgages are insured is another dimension on which they differ. There's other important things like the legal environment, which might differ across states or differ across countries. So just one important dimension here is whether or not mortgages are recourse or non-recourse. So what does that mean? Basically, a recourse mortgage is one where, if you fail to make your monthly mortgage payments, then the bank will foreclose on you, and they will take the house, and whether or not a mortgage was a recourse or a non-recourse mortgage determines whether or not the bank can subsequently go after your other non-housing assets to make to compensate them for any shortfall between the value of the house and the value of the outstanding mortgage. And whether or not mortgages are recourse or non-recourse in the US actually differs across states, and a lot of papers have used that as to provide you potentially interesting research designs to study this. So I want to talk about sort of what the set of questions are that people in this space have looked at. And, some of those we'll see papers on today and some will not. So the first type of questions is just, what determines at the household, the individual side, which mortgages people pick. And when I talk about which mortgages, I'm really thinking about all of these different dimensions that we talked about before. So which lender do you go to? How much leverage do you take? Do you pick an adjustable rate mortgage or a fixed rate mortgage, right? So these are all really important questions that affect the financial health of outcomes. And, there's a large number of papers that are, that are studying the various factors that can play a role. So Teresa is going to present a paper in a bit where we study the role that beliefs about future house price growth has on the type of leverage that you pick in a mortgage. Just like if you think back to week 2, when we talked about peer effects in consumer credit markets, peer effects can play a very large role in mortgage markets too. So, Ben McCartney has this paper where he shows that, for example, lender choice is strongly driven by, the type of lenders that your friends pick. One interesting feature of the mortgage market is that mortgage brokers play an important role as intermediaries, right? So mortgage brokers are, are professionals that can help you, originate a mortgage, and they might be able to guide you towards, mortgages that are, that are in your favor or not. But mortgage brokers have their own incentives, which might not always align with the incentives of the individual households and borrowers. And so Claudia Robles Garcia is going to present a paper today studying the incentives and the roles that mortgage brokers have in these markets. So it's an interesting part because you have, unlike, say, credit card markets, you have these intermediaries that play a very important role. More generally, what people have studied is, whether or not mortgage borrowers search appropriately, right? Do they compare enough different mortgages in order to, find the one with the lowest interest rate, the most attractive terms, etc.? So, Susan Woodward and Bob Paul have a paper here. This is very similar to some of the stuff that we saw from Chris Palmer in the first week, where he was studying whether or not people search enough when they take out car loans. Here, the question is, do people search enough when they take out mortgages? And the answer most of the time is not. right? So, the Woodward Hall paper documents that people on average look at most 2 different types of mortgages before they pick one, and they show that that leads to an enormous amount of price dispersion, that people could save a lot of money if they went out and compared more different mortgages. And so then there's a question, why don't they search more, etc. So that's questions that people have looked at. There's a second set of questions that I think is very important, which is why do individuals default on mortgages, right? So once you have a mortgage, why do individuals stop making payments? And sort of at a high level, you can think about this debate being about the extent to which your defaults are driven or can be characterized as liquidity defaults versus strategic defaults. So liquidity defaults essentially, is when you basically, because you have an income shock, whether or not it's a temporary or a permanent income shock, you really just cannot afford to make the monthly payments that you have. And so you have to, you're defaulting because you really have none of the liquidity on hand. Strategic defaults are different. So the way you can think about a strategic default is when the value of the house falls substantially below the value of the outstanding mortgage. A borrower might think, well, I can repay that mortgage, but really the amount it would take me to repay the mortgage is more than it would cost me to buy the house again. This would be primarily, an important factor after a substantial decline in house prices like we had in 2008 and 2009. And so what you can say is, in particular, if the mortgages are non-recourse, i.e. if they're only collateralized by the underlying house, you can say, well, what I'm going to do is I'm just going to default. I'll not pay my mortgage. I'll hand the house to the bank, and I can basically, not have to repay the difference between the two. And so we'll see, a presentation by Pascal Noël today on work he has with Peter Ganong, where they study how important each one of these 2 types of default are in terms of explaining the overall, prevalence of mortgage default in the US. Their conclusion, and it aligns with the conclusion of a number of other people, is that purely strategic defaults, i.e. defaults where the borrower could in principle make the mortgage payment but chooses not to, they're actually quite rare in practice. But economists think a lot about strategic default as being something that's quite important. Then peer effects, again, can play a very important role in mortgage markets. And you can think about peer effects playing an important role for mortgage default for 2 types of reasons. The first one is you might just, through your friends, just acquire information about the cost of defaulting. Right? So you might think that up front, you think, oh, I'm going to default, the bank's really going to go after me, it's going to be terrible. But once your friends have defaulted, and they can go and tell you, actually, you know what, turns out when I defaulted, it wasn't so bad in the end. And, I actually turned out okay. This type of information about the cost and the process of defaulting can lead to peer effects in mortgage default. There's also a direct effect on the social stigma cost, right? So one of the reasons that, you wouldn't want to default on a mortgage potentially is because you wouldn't want your neighbors and your friends look down on you. You don't want to be the loser that couldn't, make their mortgage payments. But the more of your friends default and the more of your friends go into foreclosure themselves, the lower the overall stigma is. And, once it becomes common enough that many people do, is that stigma cost can decline. That would be another mechanism through which peer effects can influence the desire for mortgage default. And I'm going to have Arpit Gupta present a paper today where he documents that these types of peer effects are an important source of mortgage defaults. Now, why and how individuals default on mortgages, again, will depend a little bit on the legal environment. The recourse, non-recourse laws as one important feature, which just really captures how costly it is for individuals to default on their mortgages. The strategic defaults in some sense are very uncommon if the cost of defaulting is very high. Then there's a question about mortgage refinancing behavior. This is really central. And this is really important in the US, where you have these fixed rate mortgages. So what do I mean by refinancing? Well, when interest rates are high, you sign a fixed rate mortgage where you have to pay 5% or 6% interest. Now you go into a recession, the central bank reduces the interest rate, but your current mortgage still requires you to make these 5 or 6% monthly mortgage payments. But if you went to the bank and you took out a new mortgage, you could reduce that to, maybe 2 or 3%. So really, when you're thinking about fixed rate mortgages, this type of mortgage refinancing behavior is really important. Now, what are the types of features that are important to determine it? I mean, expectations as always play an important role. So, expectations of future interest rate changes. If you think, yes, interest rates have fallen, and if I refinance now, I'll get a lower rate, but I think they're going to fall even more next year or next month or something, then you might want to push off refinancing. Peer effects again are an important role. So if you think back to Jordan Nickerson's presentation from the peer effects class, he shows that having friends go through the refinancing process makes it much more likely that you're going to refinance as well. We're going to have other frictions that play a role in terms of refinancing behavior. So, for example, Anthony DeFusco, who's going to present a different paper today, but he has a paper that shows that there are these frictions that come from the fact that in order to refinance, quite often you have to show your income. And if you lose your job during a recession, you might actually not be able to refinance because for the new loan, you won't be able to document your income, even though the bank already has lent you money at a higher interest rate. And so it would be in everybody's interest to get you to refinance, but this need to document income, for a refinance mortgage is important. Now, generally speaking, we study refinancing a lot because it really is important for the link between monetary policy and the overall economy. So if you think about how monetary policy works, and here you can think back to Neil Mahoney's presentation from the first week. If you think about how monetary policy works, the idea is I'm going to reduce the interest rate for banks. The banks are then going to reduce the interest rates for households. And households now have to make smaller interest payments, so they have more money to spend, more money to consume. They might be able to buy a car and thereby stimulate the economy. But when the reduction in interest, when everybody has fixed rate mortgages, and that's their main source of debt for most households, as I showed you before, and the central bank goes out and reduces the interest rate, if people don't refinance, their actual monthly payments don't decline at all, and it's not actually the case that they can subsequently go out and and spend much more. So really, in order for monetary policy to work, it is actually quite important to actually get individuals to refinance, which is why, in the aftermath of the financial crisis in the US, there were a number of programs, and in particular HARP, which was really designed to get households to refinance, to somehow create the incentives for households to refinance. And the reason, again, is because these types of refinances are at the heart of how people are thinking about, the stimulative effects of monetary policy. Then there's this whole set of questions about information frictions in mortgage markets. And if you think about these information frictions, they're actually quite similar to the types of information frictions that you think about in credit markets in general. You have your standard adverse selection, you have your standard moral hazard. One of the interesting elements, I think, for secured debt like mortgages is that you can think about adverse selection and information frictions to be both about borrower types as well as about collateral values. And so the paper that I'm going to present and talk about in a few minutes is all about trying to really understand what the what the types of information frictions are when, say, different banks have different information about the collateral value rather than the individual borrower. Because in order for for the mortgage to be repaid, it matters to the bank both about the quality of the borrower as well as the quality of the collateral. Then there's a question that's a set of topics that's been sort of very hot in the last few years, which is people thinking about optimal mortgage design upfront, right? So again, what are sort of the best features of mortgages? Should it be fixed rate mortgages versus adjustable rate mortgages, for example? And in the end, your answer to that question will depend on which agents in the economy you think are best placed to bear interest rate risk. There's also a number of proposals for state-dependent repayment of mortgages, right? So for example, if you really worry that strategic default is an important feature of the economy, what you may want to do is you may want to say to people, look, you have to repay smaller amounts when house prices have fallen and larger amounts where house prices have gone up. One way to think about these state-dependent repayment options is that from a lender's perspective, they start having more of what looks like an equity stake in the house rather than a pure debt stake. Because when house prices go up, these lenders get repaid more. When house prices go down, these lenders get repaid less. So in some sense, again, the way you'd want to think about this is who is best placed to bear house price risk in the economy. Right now, with a fixed rate mortgage, all the interest rate risk in some sense is borne by the lender, but without state-dependent repayment, all the price risk is borne by the borrower, and that might not be optimal. And so, it's a bunch of interesting papers trying to think about how to optimally design mortgages up front. And then there's a lot of interesting work being done trying to understand government interventions in the housing market. And so you can think, for example, about leverage caps or leverage regulations. And so the government might say, you're not allowed to have mortgages that have loan to value ratios above some amount or loan to income ratios above some amount. And we'll actually have two papers presented today, Anthony DeFusco and also Matteo Bennett, and both of whom will talk about studying sort of various leverage regulations and so on in the housing market. And again, because this market is so important from a macroeconomic perspective, and because house prices, housing is sort of the largest asset on most households' balance sheet, it really attracts a ton of government interventions on all types of dimensions, and so that attracts a lot of studying. There's also some work about whether or not these government-sponsored entities that I mentioned earlier, Fannie Mae and Freddie Mac, whether or not those should be in the business of guaranteeing mortgages, and whether or not they're guaranteeing the right types of mortgages, and if we should get rid of them. So that's an interesting policy debate. And then, in crises, when the housing market is in trouble, there's additional types of interventions that we see, whether or not it's sort of these HAMP and HARP programs, which are trying to encourage banks to modify mortgages ex post or to refinance mortgages ex post, or whether or not it's the Fed purchasing mortgage-backed securities to prop up the secondary market prices for mortgages to incentivize lenders to originate more. These are all types of government interventions in this market, and each of these is getting studied pretty extensively.